The information provided in this video is for educational and entertainment purposes only. It does not constitute professional insurance, legal, or financial advice. Insurance policies are complex legal contracts with specific exclusions, limitations, and conditions that vary significantly by provider and state of residency. You should not rely solely on this content to make insurance purchasing decisions. Always read your specific policy of insurance or description of coverage carefully, and consult with a licensed insurance agent or qualified legal professional regarding your individual circumstances. Travelers are encouraged to conduct their own due diligence and verify all coverage details with their provider before departure. Imagine you have saved for 3 years to take your family on a dream vacation to the Swiss Alps or a luxury safari in Kenya. You have spent over $15,000 on non-refundable flights, boutique hotels, and guided tours. On day 3, a freak accident or a sudden medical emergency occurs. You reach for your phone, confident that your premium travel insurance policy has your back, only to hear the words, "Claim denied," for thousands of American tourists every year. This is not a hypothetical nightmare. It is a cold, hard reality. Statistics from various industry reports suggest that a significant percentage of travel insurance claims are rejected, not because the insurance companies are inherently malicious, but because of specific, avoidable technicalities that the average traveler completely overlooks. We are talking about small checkboxes, timing errors, and misunderstood definitions that can transform a minor setback into a life-altering financial catastrophe. Today, we are conducting a deep dive masterclass into the labyrinth of travel insurance. This is not a superficial list of tips. This is a comprehensive breakdown designed to protect your bank account and your peace of mind. By the time we finish this 10-part series, you will understand the fine print better than most entry-level adjusters. We are going to bridge the gap between what you think you are buying and what is actually written in that 50-page PDF you likely ignored at checkout. If you have ever felt overwhelmed by the jargon of deductibles, primary versus secondary coverage, or the dreaded pre-existing condition waiver, this series is your definitive roadmap. We are solving the problem of financial vulnerability abroad, ensuring that when you step onto that plane, you are actually protected, not just carrying a false sense of security. To understand why this is so critical for the American traveler specifically, we have to look at the unique way our domestic systems interact with international travel. Most Americans rely on domestic health insurance providers. There is a common misconception that your standard US-based health plan will follow you across the Atlantic or the Pacific. In reality, many domestic plans offer little to no coverage outside of US borders, and Medicare almost never provides coverage for costs incurred abroad. This creates a massive coverage gap that travel insurance is supposed to fill. However, if you fill that gap with a poorly understood policy, you are essentially building a bridge out of wet cardboard. Let's look at a historical case study to illustrate the stakes. Consider a traveler we will call John, a 55-year-old from Ohio who took a cruise through the Mediterranean. John had a history of controlled high blood pressure. He bought a standard comprehensive policy, but didn't look at the stability period requirements. While in port in Italy, he suffered a cardiovascular event. The medical evacuation alone cost $60,000. When the claim was filed, the insurer looked back at his medical records and found a slight dosage adjustment his doctor had made 2 months prior to the trip. Because that adjustment fell within the policy's 90-day look-back period, the condition was classified as unstable. The pre-existing condition exclusion kicked in, and the $60,000 bill became John's personal responsibility. This is the level of detail we are dealing with. The first major mistake, and perhaps the most common, is the assumption of universal coverage. This is the belief that travel insurance is a monolithic product that covers everything from a lost suitcase to a broken leg to a change of heart about the destination. In reality, travel insurance is a modular product. It is a collection of distinct benefits, each with its own triggers, limits, and exclusions. To avoid this, you must first distinguish between trip cancellation, trip interruption, and travel medical insurance. Many travelers buy a policy thinking they can cancel if they just feel off about the trip, or if a work project comes up. Unless you have specifically purchased a cancel for any reason, or CFAR upgrade, your policy will only trigger for covered reasons. These are typically very narrow: a death in the immediate family, a documented medical emergency, or perhaps a natural disaster that renders your destination uninhabitable. If you cancel because your pet got sick or you broke up with your partner, a standard policy will typically offer zero reimbursement. Furthermore, we need to talk about the primary versus secondary distinction. This is a technical detail that can delay your reimbursement by months. If your travel insurance is secondary, it means they will not pay a single cent until you have filed a claim with every other possible source of insurance first. This includes your domestic health insurance, your credit card's built-in travel protection, and even your homeowner's insurance if it's a baggage claim. You are forced to navigate a mountain of paperwork and receive a formal letter of denial from your primary carriers before the travel insurer even opens your file. Understanding how to select a primary coverage policy is one of the most effective ways to streamline the claims process. Yet it is a detail that 90% of tourists miss during the purchase phase. Another deep-seated issue is the timing of the purchase. There is a golden window for buying travel insurance that most people ignore. While you can technically buy a policy up until the day before you depart, doing so often disqualifies you from the most robust protections. Benefits like the pre-existing condition waiver and cancel for any reason coverage almost always require you to purchase the policy within 14 to 21 days of making your initial trip deposit. If you wait until you have paid off the entire trip 3 months later, you have effectively locked yourself out of these critical safeguards. This creates a situation where a traveler is paying a premium for a policy that is functionally hollowed out because they missed a 2-week administrative window months in advance. Throughout this masterclass, we will examine the data surrounding medical evacuations. It is a common trend to see U.S. tourists underestimate the cost of specialized transport. A medevac from a remote island or a mountainous region back to a Tier 1 trauma center in the U.S. can easily exceed $100,000. Most basic credit card protections cap out at a fraction of that, or they only cover transport to the nearest adequate facility. If the nearest adequate facility is a small provincial hospital that lacks the specialists you need, you are stuck unless your policy specifically includes hospital of choice or higher tier evacuation limits. We are going to break down these complexities into actionable step-by-step checklists. We will look at how to read a schedule of benefits, how to identify the free look period, where you can cancel a policy for a full refund if the fine print doesn't meet your needs, and how to document your trip expenses to satisfy even the most rigorous claims adjuster. This isn't just about avoiding a loss. It's about the psychological freedom of knowing that your financial house is in order while you are halfway across the globe. By the end of this deep dive, you will have the tools to navigate the insurance market with the precision of a professional, ensuring that your future travels are defined by your experiences, not by your liabilities. To understand why so many claims fail, we have to look at the first major mistake: misunderstanding the pre-existing condition waiver. In 2026, medical costs globally have reached all-time highs, and insurance companies have tightened their definitions of what constitutes a stable condition. Imagine a traveler named Sarah from Chicago. Sarah has had a mild thyroid issue for 5 years, managed perfectly by a daily generic pill. 2 months before her big trip to Tokyo, her doctor noticed her levels were slightly off and adjusted her dosage by just 5 milligrams. Sarah felt fine, the trip was a go, and she bought her insurance policy a week later. While in Japan, Sarah suffered a completely unrelated fainting spell that required an overnight hospital stay and extensive diagnostic imaging. Total cost: $12,000. When Sarah filed her claim, the adjuster requested her medical records from the 90 to 180 days prior to her policy purchase. Because that 5 milligram dosage change occurred during that look-back period, the insurance company classified her entire endocrine system as an unstable pre-existing condition. They argued that any complication, even if seemingly unrelated to the fainting, could be linked back to that instability. Her claim was denied. This is the technical trap of the look-back period. Most U.S. tourists assume a pre-existing condition only refers to chronic, serious illnesses like cancer or heart disease. In the world of insurance contracts, a pre-existing condition is often defined as any injury, illness, or medical condition that caused a person to seek medical advice, receive a diagnosis, or undergo a change in medication within a specific window of time before the policy started. If you changed your blood pressure medication, started physical therapy for a tweaked knee, or even just had a diagnostic test where the results were pending, you are technically in a state of medical instability according to many standard policies. The only way to bypass this landmine is through a pre-existing condition waiver. This is not a separate policy you buy. It is a specialized provision that is added to your comprehensive plan, usually at no extra cost, provided you meet very strict criteria. First, you must be medically fit to travel on the day you purchase the policy. Second, you must insure 100% of your non-refundable trip costs. If you tell the insurance company your trip costs $5,000 but it actually costs $6,000, they may void the waiver entirely because you did not insure the full amount. Third, and most importantly, you must purchase the policy within the time-sensitive period, which is typically 14 to 21 days from the date you made your very first payment toward the trip. If you paid a $200 deposit for a hotel in January and didn't buy your insurance until the final balance was due in April, you have likely missed your chance to secure the waiver. Sarah could have avoided a $12,000 loss if she had simply bought her policy within 2 weeks of her initial flight booking. Historical trends show that travelers who secure this waiver have a significantly higher rate of successful claims because it effectively removes the look-back period from the equation. Without it, the insurance company has a legal right to audit your entire medical history for the last 6 months. They are looking for any change in health status, which is a broad term that can include new symptoms that were never even diagnosed. If you went to the doctor for a persistent headache in March and had a stroke in July, the insurer might argue the headache was the first sign of the condition, making it pre-existing. The waiver stops this investigation before it starts. The second mistake we need to dissect is relying on credit card travel insurance as a primary safety net. Many premium U.S. credit cards in 2026 offer travel protections as a perk, which leads many tourists to believe they are fully covered. This is a dangerous half-truth. Imagine Mark, a freelance designer from Austin, who booked a $5,000 trip to Peru using his high-end rewards card. He assumed the built-in insurance would cover him. While trekking, Mark suffered a severe altitude-related respiratory issue. He needed an immediate helicopter evacuation. Mark soon discovered that his credit card's medical evacuation coverage was capped at $10,000. The actual cost of the private helicopter and the medical flight back to the United States was $75,000. Mark was responsible for the $65,000 gap. Credit card insurance is almost always secondary. This means you must exhaust all other insurance options first, including your domestic health provider. Furthermore, credit card policies often have extremely low limits for medical expenses and even lower limits for emergency evacuation. While they might be excellent for a lost suitcase or a 4-hour flight delay, they are rarely designed to handle a true catastrophic medical event. They also typically exclude high-risk activities, which, in the eyes of an insurer, might include something as simple as hiking above a certain elevation or renting a moped. If you are relying on a card, you must download the Guide to Benefits and look specifically for the section titled Exclusions. You will likely find that it does not cover most medical emergencies, or it requires you to pay everything up front and wait months for a partial reimbursement. To avoid this, you should treat credit card insurance as a supplement, not a replacement. A dedicated third-party travel insurance policy provides a primary layer of protection. This means the travel insurer pays the hospital directly or reimburses you without forcing you to go through the grueling process of filing with your domestic health insurance first. In 2026, international hospitals are increasingly demanding proof of primary travel insurance or a massive cash deposit before they will even begin treatment. If you show them a credit card, they may not recognize it as valid medical coverage, leaving you in a bureaucratic limbo during a life or death situation. Step by step, you should compare your credit card's maximum medical limit against the average cost of a hospital stay in your destination. In Western Europe or Southeast Asia, medical costs for tourists can be surprisingly high, often rivaling U.S. prices for private clinics. If your card only offers $5,000 in medical coverage, you are essentially uninsured for any major accident. You also need to check if your card covers repatriation of remains. It is a grim topic, but the cost of transporting a body back to the United States can exceed $15,000. Many credit cards completely omit this benefit, whereas professional travel insurance includes it as a standard feature. By understanding these two pitfalls, the timing of the medical waiver and the limitations of credit card perks, you are already ahead of 70% of U.S. travelers. But we are just scratching the surface of how the fine print can be used against you. There is a specific legal definition for what counts as a trip that can disqualify your entire claim if you step outside your front door the wrong way. And even more surprisingly, the way you document your arrival at the airport can determine if you receive a $1,000 payout or nothing at all for a missed connection. In the next part, we are going to look at the commencement of coverage trap and why your insurance might actually expire before you even reach your destination. We will also dive into the alcohol exclusion clause, which is the #1 reason why medical claims are denied for U.S. tourists in nightlife-heavy destinations like Ibiza, Cancun, or Bangkok. If you have even one drink before an accident, your coverage could be legally voided. You need to know exactly how they prove it and how to protect yourself. The alcohol exclusion is arguably the most misunderstood and devastating clause in the modern travel insurance contract. Most American tourists assume that because they are on vacation, a few drinks at a resort or a glass of wine with dinner is perfectly acceptable. However, in 2026, many insurance carriers have moved toward a strict contributory negligence model. This means that if an insurer can demonstrate that your consumption of alcohol contributed to the incident, they have the legal right to deny the claim in its entirety. Imagine a traveler named David from Seattle who was vacationing in Cabo San Lucas. After 2 margaritas at a beachside restaurant, David was walking back to his hotel when he tripped on an uneven sidewalk and suffered a compound fracture in his leg. The medical bills for surgery and a specialized flight back to Washington state totaled $45,000. When the insurance company requested the hospital records, they saw that the attending physician had noted the smell of alcohol on David's breath. Because the policy contained an exclusion for any injury sustained while under the influence of an intoxicating substance, the claim was rejected. David was forced to liquidate his savings to cover the debt. The technicality here lies in the burden of proof. You do not necessarily have to be legally drunk by U.S. driving standards, such as having a blood alcohol content of 0.08%. Many international policies use much more ambiguous language, such as being impaired or under the influence. In some cases, if a medical report mentions alcohol consumption at all, the insurer may use that as a basis for denial, placing the burden on you to prove that the alcohol was not a factor in the accident. Historical trends in the insurance industry show that adjusters are increasingly looking for these red flags in police reports and hospital intake notes. If you are involved in a moped accident in Bali or a slip and fall in Paris, and there is any evidence of alcohol, you are entering a high-risk zone for claim denial. To avoid this, you must treat your insurance policy with the same sobriety you would a professional contract. If you plan on consuming alcohol, understand that you are effectively flying without a net for that period. The fourth major mistake is the failure to understand the adventure sports and hazardous activities exclusion. In 2026, the definition of adventure has expanded significantly, and what many U.S. tourists consider a standard vacation activity, insurers consider a high-stakes gamble. Take the case of Chloe, a physical therapist from Denver who went to New Zealand. Chloe is an experienced hiker and decided to book a guided trek that involved a short section of Via Ferrata, which is a protected climbing route using steel cables. While she was safely clipped in, a rock fall injured her shoulder, requiring an emergency evacuation. Chloe had a premium travel insurance policy and assumed she was covered because she was with a professional guide. However, her policy had a specific exclusion for mountaineering or any activity requiring the use of specialized climbing equipment or ropes. Despite being a relatively safe and common tourist activity in that region, it fell under the technical definition of a hazardous sport. Her $20,000 evacuation claim was denied. U.S. tourists often fall into this trap because they do not realize that standard policies are designed for sightseeing, shopping, and low-impact transit. Activities like scuba diving, ziplining, hot air ballooning, and even riding a horse are frequently excluded or require a specific rider. If you are planning an active vacation, you must perform a line-by-line audit of the general exclusions section of your policy. Look for phrases like professional or amateur participation in any athletic event or any activity involving a heightened risk of injury. In 2026, many insurers have even started excluding trekking above certain altitudes, often starting at 3,000 meters or roughly 10,000 feet. If you are visiting Cusco, Peru, or the base camps of the Himalayas, your standard policy might be void the moment you step off the plane due to the elevation alone. To avoid this, you must be hyper-specific during the purchase process. If you know you will be diving, you need a policy that specifically names scuba diving as a covered activity, often with stipulations that you are potty certified or diving with a certified instructor. If you are skiing, you must ensure your policy includes winter sports coverage, which often covers not just your medical bills, but also your expensive gear and prepaid lift tickets if you get injured on the first day. Without these specific add-ons, you are essentially paying for a policy that is useless for the actual purpose of your trip. The step-by-step fix is to email the insurance company before you buy and ask for a written confirmation that your specific planned activities are covered. This creates a paper trail that can be used if an adjuster tries to deny a claim based on a vague definition of hazardous. The fifth mistake is the incorrect trip duration and commencement of coverage error. This is a logistical failure that happens before you even leave your house. Many travelers set their insurance start date for the day their flight lands or the day they arrive at their destination. This is a fundamental misunderstanding of how travel insurance works. Your policy must cover the entire window from the moment you leave your front door to the moment you return. Imagine a traveler named Michael from Atlanta who was headed to London. His flight departed Atlanta at 10 p.m. on a Friday and landed in London on Saturday morning. Michael set his insurance to begin on Saturday. However, while waiting at the gate in Atlanta on Friday night, Michael tripped over a suitcase and broke his wrist, forcing him to cancel the entire trip. Because his policy didn't technically start until the following day, he had zero coverage for the cancellation or the medical bills. In 2026, the complexity of international flight paths and time zone changes makes this mistake even more common. Your coverage must be active during your transit. If you have a layover in a third country and that country experiences a natural disaster or a political uprising that strands you, you are only covered if your policy dates encompass that transit time. Furthermore, if you decide to extend your trip while you are already abroad, you cannot simply buy a new policy or extend your current one without a break in coverage. Most insurers will not allow you to buy a policy once you have already left your home country, or they will impose a waiting period of 48 to 72 hours before the new coverage becomes active. This leaves you completely vulnerable during that gap. Historical trends show that insurers are becoming more rigid about these timestamps. They will look at the flight manifest and your boarding pass to see exactly when an incident occurred. If you were injured at 11:59 p.m. and your policy started at midnight, you are out of luck. The step-by-step solution is to always pad your insurance dates by one day on each end. Start the policy the day before you leave, and end it the day after you are scheduled to return. This accounts for flight delays, transit to the airport, and the possibility of being stuck on the tarmac. The cost of adding an extra 48 hours of coverage is usually negligible, often less than $10, but it prevents a total loss of benefits due to a minor scheduling error. We have now covered the dangers of alcohol, the traps of adventure activities, and the critical importance of timing your coverage. But there is a massive hidden factor that determines how much money you actually get back, and it revolves around the concept of non-refundable costs. Many travelers unknowingly overinsure or underinsure their trips, leading to either wasted premiums or massive out-of-pocket losses. We are also going to explore the terrifying world of medical repatriation and why the phrase "nearest adequate facility" is the most dangerous sentence in your insurance contract. If you don't know the difference between being moved to a local clinic and being flown back to a U.S. hospital, you could find yourself stranded in a facility that doesn't speak your language or have the equipment to save your life. In the next part, we will break down the exact math of trip valuation and the secret to ensuring you are flown home to your own doctors no matter where you are in the world. The sixth common mistake is the failure to distinguish between medical evacuation and hospital of choice. This is perhaps the most dangerous semantic trap in the entire insurance industry. In 2026, most comprehensive policies include a benefit called emergency medical evacuation, often with limits ranging from $100,000 to $1 million. To an American tourist, this sounds like an ironclad safety net. However, if you do not read the fine print, you will miss the phrase "nearest adequate facility." This is the legal standard used by the majority of travel insurers. Imagine a traveler named Robert from Miami, who was visiting a remote region of the Amazon in Brazil. Robert suffered a severe neurological event that required immediate specialized surgery. His insurance company agreed to a medical evacuation, but under the nearest adequate facility clause, they only authorized transport to a regional hospital in a nearby city that had basic surgical capabilities. Robert's family wanted him flown back to a top-tier neurology center in Miami, where his own doctors and support system were located. The insurance company refused to pay for the international flight, which cost $85,000, because the local Brazilian hospital met the technical definition of adequate. Robert was stuck in a facility where he did not speak the language, where his family could not easily stay, and where the standards of care were significantly different from what he was accustomed to in the United States. Historical trends in the industry show that these disputes are incredibly common because adequate is a subjective term defined by the insurer's medical director, not by the patient or their family. To avoid this, you must look for a policy that includes a hospital of choice or bed-to-bed repatriation rider. This specific language ensures that if you are hospitalized and stable enough for transport, The insurance company will cover the cost of flying you back to a hospital in the United States. This is a massive logistical undertaking involving specialized air ambulances, onboard medical staff, and complex international flight clearances. Without this specific wording, the insurer's only legal obligation is to get you to a place that can stabilize you. Step by step, when you are shopping for a policy in 2026, you should search the policy document for the word repatriation. If the policy only mentions evacuation to the nearest facility, you are essentially leaving your long-term recovery to chance. You want a policy that explicitly states they will transport you to a hospital near your primary residence once you are cleared for travel. Furthermore, we must address the seventh mistake: miscalculating and underreporting trip costs. This is a math error that can lead to the total forfeiture of your most important benefits. Many U.S. tourists try to save money on their insurance premium by only insuring a portion of their trip. For example, if a trip to Italy costs $10,000, a traveler might only insure $5,000, thinking they are at least getting some protection. This is a catastrophic error because it can invalidate the pre-existing condition waiver and the cancel for any reason benefit. As we discussed earlier, these specific protections usually require you to insure 100% of your non-refundable trip costs. Imagine a traveler named Amanda from Philadelphia who booked a dream cruise through the Greek Isles. The total cost, including airfare in the cabin, was $8,000. Amanda decided to only insure $4,000 to keep her premium low. 2 weeks before the trip, Amanda's father fell ill, and she had to cancel. When she filed her claim, the insurance company requested documentation for all trip expenses. Once they realized she had only insured 50% of the total cost, they denied the claim for the pre-existing condition waiver because she had failed to meet the 100% insurance requirement stipulated in the contract. Amanda lost her entire $8,000 because she tried to save $50 on the insurance premium. The math of trip valuation is precise. In 2026, you must include every non-refundable expense: the flights, the hotel deposits, the prepaid tours, and even the non-refundable train tickets between cities. If you add a tour or upgrade your room after you buy the policy, you have a limited window, usually 14 days, to call your insurer and increase your coverage amount to reflect the new total. If you forget this step, you are no longer insuring 100% of your costs, and your high-level protections can vanish. Case studies of denied claims frequently point to this discrepancy. Insurers will ask for your credit card statements and booking confirmations. If the numbers don't match the insured amount, they have a legal path to deny the claim. To avoid this, you should keep a running spreadsheet of every non-refundable dollar you spend. The moment you pay a deposit, it goes on the list. When you purchase your policy, use that exact total. If you have costs that are refundable up until 48 hours before the trip, you do not necessarily need to include them. But the moment they become non-refundable, you must update your policy. This is the difference between a professional approach to travel and a gamble. By ensuring the math is perfect, you are locking in the legal protections that you paid for. Another layer of this valuation mistake involves overlooking the difference between trip cancellation and trip interruption. While most people focus on cancellation before the trip starts, trip interruption is what covers you if you have to go home early. If you are on day 5 of a 14-day trip and a family emergency occurs, trip interruption covers the cost of your one-way flight home and reimburses you for the unused portion of your hotels and tours. However, these benefits are also tied to your initial valuation. If you underinsured the trip, your interruption limit will be equally stunted, leaving you to pay for a last-minute, full-fare international flight out of pocket. In 2026, these last-minute tickets can cost upwards of $3,000 per person. Let's look at a case study of a group of friends from New York who traveled to Japan. They each booked their flights separately but shared a large villa in Kyoto. One friend, Jason, paid for the entire villa on his card, and the others Venmo'd him. When the trip was interrupted by a local emergency, the friends who Venmo'd Jason struggled to get reimbursed by their insurance companies. Why? Because the insurance companies require a formal receipt from a commercial provider. A Venmo transaction to a friend does not always count as a documented travel expense in the eyes of a strict adjuster. To avoid this, Jason should have provided each friend with a formal, signed statement or a sub-invoice, or better yet, each person should have paid the villa provider directly. This level of administrative detail is what separates a successful claim from a total loss. We have now explored the high-stakes world of medical repatriation and the mathematical precision required for trip valuation. You now know that adequate is a dangerous word and that 100% means exactly 100%. But even if you get the math right and choose the right hospital, there is a silent killer of insurance claims that happens the moment you speak to a representative. The way you report an incident and the specific words you use can trigger an automatic denial before you even file the paperwork. In the next part, we are going to dive into the art of the claim. We will discuss the specific documentation you must collect while you are still on the ground in a foreign country, and why waiting until you get back to the United States to gather evidence is the biggest mistake of all. We will also reveal the secret of the 24-hour rule, a time frame that most travelers ignore, but that insurers use to disqualify thousands of baggage and theft claims every single year. If you don't have a specific type of paper from a local authority within that window, your claim is dead on arrival. The 24-hour rule is the invisible wall that separates a successful claim from a total loss of reimbursement. In 2026, travel insurance companies have digitized their claims processes, but they have also become more forensic in their requirement for immediate documentation. This brings us to the 8th massive mistake: failing to secure a local report within one day. Imagine a traveler named Kevin from Phoenix who was enjoying the bustling night markets of Ho Chi Minh City, Vietnam. While distracted by a street food stall, a professional pickpocket swiped Kevin's high-end smartphone and his wallet, which contained over $500 in local currency, and his primary credit cards. Kevin was rattled and decided to deal with it when he got back to his hotel. Exhausted, he slept in, spent the next day trying to cancel his cards, and finally went to the local police station 48 hours after the incident. When Kevin returned to Arizona and filed his claim for the $2,000 phone and the stolen cash, the insurance adjuster pointed directly to the section in his policy titled "Your Duties in the Event of a Loss." This clause explicitly stated that all thefts must be reported to the local authorities, a hotel manager, or a tour operator within 24 hours of discovery. Because Kevin waited 2 days, his claim was summarily denied. The insurance company argued that by waiting, Kevin deprived them of the opportunity to verify the incident and allowed for the possibility of a fraudulent claim. For U.S. tourists, the 24-hour rule is a non-negotiable deadline that applies to stolen baggage, criminal activity, and even common airline mishaps. Historical trends show that insurers rely on the timestamp of a police report or a property irregularity report from an airline as the primary piece of evidence. If you are at the airport and your suitcase does not come off the carousel, you cannot simply go to your hotel and call the airline the next morning. You must stand in line at the baggage claim office and get a physical or digital PIR document before you leave the airport. That document is your golden ticket. Without it, the insurance company will assume the bag was lost at your hotel or left in a taxi, which might fall under a different, less comprehensive coverage category or be excluded entirely as a result of personal negligence. To avoid this, you must treat every loss as a race against the clock. Step by step, if you are a victim of theft, your first call should be to the local police. If there is a language barrier, find a hotel concierge or a tour guide to act as a translator, but do not leave without a case number or a written statement. In 2026, many major tourist cities have specialized tourist police branches designed to handle these reports quickly. If the police refuse to take a report for a minor item, you must document that refusal. Note the name of the officer, the time you visited, and the location of the station. This shows the insurance company you conducted your due diligence. For airline issues, take a photo of your baggage tags and the empty carousel. These digital timestamps provide a secondary layer of proof that aligns with your narrative. This leads us directly into the 9th mistake: the misinterpretation of reasonable care and the negligence trap. Many U.S. travelers believe that because they have baggage insurance, they are covered regardless of how a loss occurs. This is a dangerous misconception. Insurance is designed to cover the unexpected, not the avoidable. In the world of travel insurance, there is a legal standard called reasonable care. This means you must act as if you do not have insurance. If you leave your high-end camera on a table in a public cafe while you go to the restroom, or if you leave your designer luggage in the backseat of a rental car in plain sight, the insurance company will likely classify the loss as a result of negligence. Case studies from 2026 highlight a surge in denied claims for items stolen from rental vehicles. Many policies have a specific exclusion for electronics and jewelry left in a car, even if the car was locked and the windows were smashed. Insurers argue that a reasonable person would not leave $4,000 worth of laptops and cameras in an unattended vehicle. Imagine a family from San Diego driving through the south of France. They stopped for lunch at a scenic overlook, leaving their suitcases in the trunk. While they were eating, thieves broke into the car and cleared out everything. The insurance company covered the cost of the suitcases and the clothing, but they denied the claim for the 2 MacBooks and the professional DSLR camera because the policy explicitly required those items to be on the person or in a secure hotel safe. To avoid the negligence trap, you must read the unattended property clause in your policy. You will find that most insurers define unattended as any time the property is not under your direct supervision or in a locked, permanent residence or hotel safe. A locker at a hostel or a luggage storage room at a train station may not meet the definition of a secure location. Step by step, you should assume that your high-value items are only covered when they are physically on your body or locked in a room safe. If you must leave items in a car, they must be in a locked trunk that is not visible from the outside. But even then, the coverage for electronics is often capped at a very low limit, such as $500, regardless of the item's actual value. Furthermore, we must discuss the importance of the original receipts requirement. In 2026, insurance companies are no longer accepting estimated values for high-end goods. If you claim that a stolen watch was worth $3,000, you must provide a copy of the original purchase receipt. If you received the item as a gift or bought it years ago and lost the receipt, the insurer may only offer you the depreciated value of a generic equivalent, which could be as low as $200. For American tourists who often travel with expensive gear, this can result in a massive financial gap. Historical data suggests that travelers who maintain a digital asset folder have a 90% higher success rate in baggage claims. Before you leave the United States, you should take a photo of every expensive item you are packing. Take a photo of the serial number and the item itself. Then, upload a digital copy of the original receipt to a secure cloud drive. If an item is stolen, you can instantly provide the adjuster with the photo of the item, the proof of its value, and the police report. This level of organization makes it nearly impossible for an adjuster to find a reason to lower the payout. It transforms your claim from a verbal assertion into a documented fact. We have addressed the critical timeline of reporting and the legal definition of care, but there is an even more nuanced mistake that happens during the medical treatment phase. It involves the difference between an in-network and out-of-network facility in an international context. Many travelers do not realize that their insurance company has a 24/7 assistance center that is designed to do more than just answer questions. They are actually the gatekeepers of your coverage. If you seek treatment without calling them first, you might find yourself in a facility that the insurance company refuses to pay directly, forcing you to front thousands of dollars on your own credit cards. In the next part, we are going to break down the concept of pre-authorization and why your first call during a medical crisis should never be to your family, but to a specific phone number on your insurance card. We will also reveal the hidden danger of the pre-existing condition look-back period once again, but from a different angle. How a seemingly healthy checkup 3 months ago can be used as a legal weapon to void your entire policy today. If you have had a routine screening or a change in a vitamin supplement, you are more at risk than you think. The 10th major mistake, and perhaps the most administratively punishing, is the failure to obtain pre-authorization before seeking non-emergency medical care. In 2026, the global medical landscape has become increasingly fragmented, and travel insurance companies have responded by implementing strict managed care protocols similar to domestic U.S. health maintenance organizations. Imagine a traveler named Emily from Boston who was visiting Florence, Italy. On the 4th day of her trip, Emily developed a severe, persistent ear infection. Fearing a ruptured eardrum before her flight to Athens, she walked into a high-end private clinic she found on a search engine. She underwent a series of diagnostic tests, saw a specialist, and was prescribed advanced antibiotics. The bill was $2,400. Emily paid with her credit card, assuming she would simply email the receipt to her insurer for a quick reimbursement. When Emily filed her claim, it was rejected for a lack of prior notification. Her policy, like most comprehensive plans in 2026, contained a clause stating that for any non-life-threatening medical service, the traveler must contact the 24/7 Assistance Center first. By failing to call that number on the back of her insurance card, Emily bypassed the insurer's ability to direct her to a preferred provider or to negotiate the rates beforehand. More importantly, the insurer argued that they could not verify if the treatment was medically necessary or if a more cost-effective alternative was available. Historical trends show that insurers are increasingly using the lack of pre-authorization as a primary legal lever to deny claims, even when the medical need is legitimate. To avoid this, you must understand the role of the assistance center. This is not just a customer service line. It is a clinical gatekeeper. Step by step, if you feel ill but are not in immediate life-threatening danger, your first action must be to call the insurer. They will often provide a telehealth consultation with a US-based or Western-trained doctor who can determine if you need to visit a clinic. If you do need an in-person visit, the assistance center will issue a letter of guarantee to a local hospital or clinic. This letter is a legal document that tells the hospital the insurance company will pay the bill directly. This prevents you from having to shell out thousands of dollars of your own money and ensures the claim is approved before you even walk through the clinic doors. Furthermore, we need to address the deep-seated complexity of the medical necessity definition. In 2026, what a traveler deems necessary and what an insurance adjuster deems necessary can be worlds apart. Imagine a traveler named Marcus from Dallas who was in London and experienced sharp abdominal pain. He went to a private emergency room and requested an MRI because he was worried about appendicitis. The doctors performed the scan, found it was merely a severe case of food poisoning, and sent him home with a $5,000 bill. The insurance company denied the portion of the claim related to the MRI, arguing that a standard physical exam and blood test would have been the appropriate first steps. Because Marcus jumped straight to the most expensive diagnostic tool without insurer oversight, he was left holding the bill for the imaging. Historical case studies suggest that travelers who allow the insurance company's medical team to coordinate with the local doctors have a much higher success rate. This coordination is the only way to ensure that every test and procedure performed is considered a covered expense. If you are unconscious or in a true emergency where every second counts, the pre-authorization requirement is typically waived. But the moment you are stabilized, you or a family member must contact the insurer to begin the formal monitoring process. In 2026, many policies even require daily updates from the treating physician to the insurance company's medical director to continue coverage. The 11th mistake involves the total misunderstanding of the look-back period in relation to routine wellness and minor adjustments. Most Americans believe that if they are healthy enough to work and go to the gym, they are healthy enough for travel insurance. However, in 2026, insurers have expanded their definition of a change in health to include even the most mundane medical interactions. Consider a traveler named Linda from Seattle. 3 months before her trip to Portugal, Linda went to her doctor for a routine annual physical. During the visit, the doctor noted that her vitamin D levels were slightly low and suggested she start taking a standard over-the-counter supplement. Linda didn't think twice about it. While in Lisbon, Linda tripped and broke her hip. During the claims process, the insurer reviewed her medical records from the 180-day look-back period. They saw the doctor's note about the vitamin D supplement. In a stunning display of contract technicality, the insurer argued that because a new treatment was initiated during the look-back period, Linda did not meet the definition of stable. They then attempted to link the vitamin D deficiency to bone density issues, arguing that the hip fracture was a complication of a pre-existing, unstable condition. While this may sound extreme, historical data from 2026 shows that insurance companies are increasingly scrutinizing routine wellness checks for any deviation from the status quo to trigger an exclusion. To avoid this, you must be brutally honest with yourself during the look-back period. If you have had any new symptoms, any change in medication, even a change in dosage or a switch to a generic version, or any diagnostic test, you must assume you have a pre-existing condition. The only way to protect yourself is the pre-existing condition waiver we discussed in Part 2. But there is a catch. That waiver only works if you disclose the condition if asked. If you represent yourself as having no medical history on the application but your records show a wellness check with a new supplement recommendation, the insurer can claim material misrepresentation and void the entire policy, not just the medical portion. Step by step, the solution is to request a copy of your own medical records for the 6 months prior to your trip. Look for any new ICD-10 codes or doctor's notes that indicate a new complaint or a change in a treatment plan. If you see anything, ensure you buy your insurance within the 14-day window of your first trip deposit to secure that waiver. Many U.S. tourists skip the waiver because they think they are healthy, not realizing that the insurance company's definition of healthy is a person who has had 0 medical interactions, 0 new prescriptions, and 0 pending tests for the last half year. Finally, we must talk about the secondary payer trap during the reimbursement phase. If your policy is secondary, the insurance company will often demand a coordination of benefits from your domestic U.S. health provider. In 2026, Some U.S. health insurers have become notoriously slow at providing the necessary denial letters for international claims. This can leave a traveler in a state of financial limbo for 6 to 12 months, carrying a high-interest balance on a credit card, while waiting for the travel insurer to step in. Case studies show that travelers who do not have a primary policy often give up on their claims entirely because the administrative burden of filing twice, once with their domestic plan and once with the travel insurer, is too overwhelming. We have now pulled back the curtain on the administrative minefields of pre-authorization and the shocking sensitivity of the medical look-back period. You now know that a simple vitamin recommendation can be a legal liability, and that your insurance company wants to be your first call, not your last. But there is another, even more frustrating category of mistakes that involves the actual logistics of travel: the missed connection. In 2026, flight delays are at an all-time high, but the reasons for those delays are being categorized in ways that can leave you stranded without a cent of coverage. In the next part, we are going to explore the difference between a mechanical delay and a weather delay, and why that distinction is the difference between a free hotel room and sleeping on the airport floor. We will also dive into the strike and civil unrest clauses. If a labor strike or a political protest shuts down an airport, your policy might have a specific waiting period that you must endure before you can claim a single dollar for food or lodging. If you don't know the exact hour count of your policy's delay trigger, you are flying blind. The 12th critical mistake is ignoring the minimum delay trigger required for travel delay and missed connection benefits. In 2026, air travel logistics have become increasingly volatile, yet insurance companies have pushed their required delay windows further out to mitigate their own risk. Many U.S. tourists assume that if their flight is delayed by 2 or 3 hours, causing them to miss a non-refundable tour or a connecting flight, the insurance company will automatically step in to cover the costs. This is almost never the case. Most comprehensive policies in 2026 have a specific hour count trigger, usually ranging from 6 to 12 hours, before any travel delay benefits become active. Imagine a traveler named Christopher from San Francisco who was flying to Rome with a tight connection in Munich. His first flight was delayed by 3 hours due to a late arriving aircraft. This 3-hour delay caused Christopher to miss his connection to Rome, and the next available flight wasn't until the following morning. Christopher had to book a last-minute airport hotel for $300 and buy dinner. When he filed his claim, it was denied. Why? Because his policy's travel delay trigger was 6 hours. Even though the delay caused a massive ripple effect that cost him hundreds of dollars and a full day of his vacation, the initial delay event did not meet the 6-hour minimum threshold required to activate the coverage. Historical trends show that insurers are very strict with these timestamps. They do not look at how long you were delayed at your final destination. They look at the duration of the specific event that caused the delay. To avoid this, you must check the schedule of benefits for the specific hour requirement for travel delay. If you are a traveler who prefers tight connections, you should look for premium policies that offer a 3-hour or 4-hour trigger. Step by step, you should also verify if your policy covers missed connections specifically. This is a separate benefit from travel delay. While travel delay covers your out-of-pocket expenses like food and lodging, missed connection coverage is what pays for the change fees or the new ticket required to catch up to your cruise or tour group. In 2026, if you are booking a cruise, you should never settle for a policy with a missed connection trigger longer than 3 hours, as even a small delay can result in the ship leaving port without you. The 13th mistake is failing to distinguish between a mechanical delay and a weather delay in the context of strike and civil unrest clauses. In 2026, labor strikes in the European aviation sector and climate-related weather events have become common occurrences. However, these are handled very differently by insurance adjusters. Imagine a traveler named Jennifer from Nashville who was heading to Paris. Her flight was canceled because the local air traffic controllers went on strike. Jennifer assumed her insurance would cover her new flight and her lost hotel night. However, her policy had a specific clause stating that for a strike to be a covered reason for cancellation or delay, the strike must not have been announced or threatened at the time the policy was purchased. Because the strike had been mentioned in international news headlines 3 days before Jennifer bought her policy, the insurer classified it as a known event. In the world of insurance, you cannot buy a policy to cover a house that is already on fire. Historical case studies from 2026 show that insurance companies now use sophisticated media monitoring algorithms to determine the exact date an event became known. If you buy your insurance the day after a hurricane is named or a strike is announced, that specific event is excluded from your coverage. To avoid this, the step-by-step solution is to buy your insurance immediately after making your first trip deposit, long before any potential disruptions appear on the news cycle. Furthermore, we must address the 14th mistake, the documentation deficit for travel delays. If your flight is delayed, the insurance company will not take your word for it, nor will they simply look at a screenshot from a flight tracking app. They require an official statement of delay from the airline. This is a formal document that specifies the flight number, the original departure time, the actual departure time, and the specific reason for the delay, such as mechanical failure or weather. In 2026, airlines have made it increasingly difficult to get these documents after you leave the gate. Imagine a traveler named Daniel from Chicago who was stuck in a 10-hour delay in London. He was so frustrated that he just wanted to get home and didn't stop at the customer service desk. When he tried to claim his $200 in meal expenses and his hotel stay, the insurer demanded the airline's official statement. The airline's website was unresponsive, and the phone support wait times were 5 hours. Daniel never got the document and his claim was closed for lack of evidence. To avoid this, you must secure this document while you are still at the airport. Many airlines in 2026 provide a digital version via their app or a QR code at the gate, but you must ensure it explicitly states the reason for the delay. If the reason is not a covered peril in your policy, the claim will fail. The 15th mistake involves the improper handling of rental car damage waivers. Many U.S. tourists buy a travel insurance policy that includes rental car damage coverage, thinking they can skip the expensive insurance offered at the rental counter in a foreign country. While this can be a great way to save money, it requires a very specific set of actions to be valid. In 2026, many international rental agencies, particularly in countries like Italy, Ireland, and Mexico, have become extremely aggressive about inspecting vehicles for microscopic damage. If you rely on your travel insurance for rental car protection, you are almost always dealing with a reimbursement-based system. This means that if you scratch the car, the rental agency will charge your credit card for the full estimated repair cost immediately, often $3,000 or more. You then have to file a claim with your travel insurer to get that money back. The mistake occurs when the traveler does not realize that certain types of vehicles are excluded. Most travel insurance rental car benefits exclude luxury vehicles, motorcycles, large vans, and off-road vehicles. If you rent a specialized 4x4 for a desert excursion in Morocco, and it gets damaged, your standard travel insurance rental benefit will likely provide zero coverage. Historical data from 2026 suggests that travelers who do not take a 360-degree video of the car at both pickup and drop-off lose 60% more of their security deposits to dubious damage claims. To avoid this, you must treat the rental car inspection as a legal evidentiary process. Step by step, you should verify the maximum limit of your rental car benefit. If the car is worth $50,000 but your policy only covers $35,000, you are personally liable for the difference in the event of a total loss. Additionally, you must ensure you have declined the rental company's collision damage waiver in writing on the contract, as some travel insurance policies will not pay if you have already purchased a duplicate, primary protection from the agency. We have now navigated the complexities of our counts, known events, and rental car logistics. You now know that a 3-hour delay can be just as expensive as a 10-hour delay but significantly harder to claim, and that the word known is a legal trap for anyone who buys insurance too late. But there is one final, overarching mistake that can nullify every single benefit we have discussed so far. It is a mistake of character and disclosure that happens during the application process, and it is something that U.S. tourists often do unintentionally while trying to be helpful. In the next part, we are going to dive into the danger of material misrepresentation. We will discuss why being honest about your itinerary is just as important as being honest about your health. If you plan to spend 2 days in a country that is on the U.S. State Department's Level 4 travel advisory list, but you don't tell your insurer because you are spending the rest of your month in a safe zone, you could be voiding your entire policy. We will also reveal the secret of the beneficiary designation, a small line at the bottom of the form that determines who gets your life insurance payout if the worst should happen. If you leave it blank, your family could be tied up in probate court for years while they are grieving. This brings us to the 16th mistake: material misrepresentation during the application process. In 2026, the data sharing between government travel databases and insurance underwriting software has reached a level of unprecedented transparency. Many American tourists inadvertently misrepresent their plans, thinking that small details do not matter. Imagine a traveler named Samantha from San Diego who was planning a 6-week journey across the Middle East. She spent 5 weeks in Jordan and Oman, but she also spent 4 days in a neighboring country that was currently under a level 4 do not travel advisory from the U.S. State Department. When she purchased her policy, she only listed Jordan and Oman as her destinations because that is where she spent the bulk of her time and her money. While Samantha was in a perfectly safe area of Muscat, Oman, she suffered a severe allergic reaction to seafood that required 3 days of intensive care. When she filed her medical claim, the insurance company requested a full copy of her passport stamps. When they saw the entry and exit stamps for the level 4 country, they denied her entire claim, even though the medical emergency happened in a different safe country. The reason was material misrepresentation. By failing to disclose that she would be entering a high-risk zone, Samantha deprived the insurer of the chance to accurately assess the risk of the entire trip or to decline coverage altogether. In the eyes of the law, the policy was void from the moment it was issued. Historical trends show that insurers are increasingly using passport audits to verify itineraries. To avoid this, you must list every single country you plan to touch, even if it is just a long layover where you leave the airport for dinner. If your plans change while you are mid-trip, you must call or email your insurer to add the new destination. In 2026, many policies have a specific exclusion for any loss occurring in a country under a level 4 advisory, but failing to mention you are going there can kill your coverage for the safe parts of your trip as well. Step by step, you should verify the current State Department rating for every stop on your list and ensure your insurer acknowledges each one in your policy declaration. The 17th mistake is the blank beneficiary trap. Every comprehensive travel insurance policy for U.S. citizens includes an accidental death and dismemberment or AD&D benefit. This is essentially a temporary life insurance policy that pays out a significant sum, often between $50,000 and $500,000, if a fatal accident occurs during the trip. However, during the hurried online checkout process, many travelers leave the beneficiary section blank or assume it naturally defaults to their spouse or children. Imagine a traveler named Gregory from Atlanta, a widower with 2 adult children. Gregory left the beneficiary line blank when he bought his policy for a solo trip to the Swiss Alps. Tragically, Gregory was involved in a fatal transit accident. Because there was no named beneficiary, the 6-figure insurance payout did not go directly to his children to cover immediate expenses. Instead, the money was paid into his estate. This triggered a complex probate process in Georgia that took 18 months to resolve, during which time his children had to pay out of pocket for the international repatriation of his remains and legal fees. Case studies from 2026 show that a single missing name on an insurance form can result in thousands of dollars in lost interest and legal exhaustion for grieving families. To avoid this, you must manually enter a primary and a contingent beneficiary. Do not assume that your will or your domestic life insurance settings carry over to your travel policy. They do not. This is a standalone contract. If you are traveling as a couple, ensure you do not name each other as the sole beneficiaries without a contingent, as a common accident involving both parties would lead back to the same probate nightmare. Step by step, you should take 30 seconds during the application to type out the full legal names and contact information of your intended heirs. The 18th mistake involves the failure to document the pre-existing condition of your gear. We have talked extensively about medical pre-existing conditions, but in 2026, the same logic is being applied to high-value electronics and luggage. Most travelers know they can claim a stolen laptop, but they do not realize that the insurer will deduct for depreciation and prior damage. Imagine a photographer named Tyler from Portland, who traveled with $10,000 worth of camera equipment. His gear was stolen from a locked hotel safe in Berlin. Tyler had the original receipts, but the insurance company offered him only $4,000. Their argument was that the equipment was 3 years old and showed signs of heavy use in the photos Tyler had posted on social media months prior. Historical trends in baggage claims suggest that adjusters are now scanning public social media profiles to assess the condition of claimed items. If you claim a mint-condition suitcase was destroyed, but your Instagram shows that same suitcase looking battered and taped together a year ago, your claim will be adjusted downward or denied for fraud. To avoid this, you must perform a pre-departure gear audit. Step by step, take a high-resolution video of your expensive items on the day you pack. Turn the electronics on to show they are functional. Record the serial numbers and the physical condition of the screens and casings. This video serves as your proof of the pre-loss condition, making it much harder for an insurer to apply excessive depreciation. The 19th mistake is the misunderstanding of the medical stability window for non-traveling family members. This is one of the most heartbreaking reasons for claim denials. Most U.S. tourists know that if they get sick, they can cancel their trip. They also know they can cancel if a parent or child at home has a medical emergency. However, the pre-existing condition rules also apply to that person at home. Imagine a traveler named Olivia from Minneapolis who booked a trip to Iceland. Her elderly mother in Florida had been dealing with chronic heart issues for years, but was currently stable. A month before the trip, her mother had a minor checkup where the doctor noted some increased fatigue. Olivia didn't think this mattered because her mother wasn't the one traveling. 2 days before the flight, Olivia's mother suffered a major heart attack, and Olivia canceled her trip to be by her side. The insurance company denied the claim because the mother's condition was not stable during the policy's look-back period. Because the doctor had noted fatigue a month prior, the heart attack was considered a complication of an unstable pre-existing condition, even though the mother was not on the policy. Case studies from 2026 show that travelers often forget that their insurance coverage is inextricably linked to the health of their immediate family members back home. To avoid this, you must ensure that your pre-existing condition waiver specifically covers non-traveling family members. Not all waivers are created equal. Some only waive the exclusion for the people actually on the plane. If you have elderly parents or family members with chronic health issues, you must confirm in writing that the waiver extends to them. This ensures that if their health takes a turn for the worse, your investment in your trip is protected. We have now explored the legal minefields of destination disclosure, the administrative vitalness of beneficiary naming, and the surprising way the health of people not even on your trip can derail your finances. You are now equipped with the knowledge to handle the most complex parts of the application and the most obscure clauses in the contract. But there is one final hurdle: the actual moment of the crisis. There is a specific protocol for how you must pay for emergency services that, if done incorrectly, can leave you with a debt that even a perfect policy won't cover. In the next part, we are going to discuss the financial logistics of a crisis. We will look at the difference between direct billing and reimbursement, and why your credit card limit might be your most important travel document. We will also reveal the secret of the emergency cash transfer, a little-known service that can get you money when your bank accounts are frozen or your wallet is at the bottom of the ocean. If you think your ATM card is enough, you haven't seen what happens when an international bank flagging system decides to lock you out in the middle of a medical emergency. The 20th mistake is failing to prepare for the out-of-pocket reality of international medical care. In 2026, even the most comprehensive travel insurance policies often operate on a reimbursement basis rather than direct billing, especially for outpatient services or smaller clinics. Many U.S. tourists assume that showing their insurance card at a foreign hospital is the equivalent of presenting a Blue Cross card at a domestic provider. This is a dangerous assumption that can lead to immediate financial paralysis. Imagine a traveler named Ryan from Denver who was exploring the street food scene in Bangkok. Ryan contracted a severe case of salmonella that required a 3-day stay in a private international hospital. Upon discharge, the hospital presented him with a bill for $6,000 and stated they would not release his medical records or allow him to check out until the balance was settled in full. Ryan called his insurance company, but because it was a weekend and the hospital's billing department was understaffed, the insurer could not establish a letter of guarantee in time. Ryan was forced to put the entire $6,000 on his personal credit card. However, because he had already been spending heavily on his vacation, the transaction put him over his limit, and his card was declined. He was stuck in a foreign country, medically recovered but financially detained. Historical trends in 2026 show that private hospitals in popular tourist destinations like Thailand, Mexico, and Turkey are increasingly demanding payment upfront from foreigners, regardless of their insurance status. To avoid this, the step-by-step solution is to ensure you have a dedicated emergency credit line, with a minimum of $10,000 in available credit specifically for your trip. This is not for shopping or excursions. This is your medical bridge. Furthermore, you must notify your bank of your specific travel dates and destinations to prevent the automated fraud detection systems from freezing your accounts during a high-value transaction at a hospital. Case studies from 2026 highlight that the most stressful part of a travel emergency is often not the medical condition itself, but the frantic calls to banks in different time zones trying to unlock a credit card, while a hospital administrator is demanding payment. This leads to the 21st mistake: underestimating the power of the 24/7 assistance services for financial logistics. Most travelers view their insurance only as a way to get paid back after the fact. In reality, the most valuable part of your 24/7 assistance plan is the emergency cash transfer and the bail bond coordination. Imagine a traveler named Chloe from Austin who was driving a rental car in a rural part of Greece. She was involved in a minor fender bender with the local driver. In that specific jurisdiction, the local police required a cash deposit for the estimated damages before she was allowed to leave the area. Chloe's wallet had been lost in the confusion of the accident, and she had no access to her funds. In this scenario, Chloe's travel insurance provided an emergency cash transfer service. The insurer worked with her family in Texas to secure funds, and then used their global network to make those funds available to Chloe through a local Western Union or a partner bank within 4 hours. Without this service, Chloe might have faced a night in a local detention center. Historical data suggests that while these financial services are rarely used, they are the difference between a minor delay and a legal nightmare. You must check your policy to see if it includes cash wire assistance and legal referral services. These are the logistical backbones that keep you moving when your primary financial tools fail. The 22nd mistake is the failure to maintain a parallel paper trail during a crisis. In 2026, the digital divide between international hospitals and US-based insurance adjusters is still significant. If you are hospitalized, the hospital might send a digital file to your insurer, but those files are often incomplete or improperly coded for US insurance standards. Imagine a traveler named Brandon from Chicago who had a mountain biking accident in Switzerland. The hospital billed for a surgical procedure using a local coding system that did not translate directly to the US standard CPT codes. The insurance company denied the claim because they could not verify that the procedure was a covered medical necessity under their specific definitions. To avoid this, you must act as your own medical scribe. Step by step, every time a doctor enters your room, you should ask for a business card or their full name and title. Every time a test is performed, ask for a printed copy of the results or a summary of the findings. Most importantly, before you leave the facility, you must request a discharge summary written in English, if possible, that clearly outlines the diagnosis, the treatment provided, and the medical necessity for that treatment. If the hospital refuses or says they will email it later, do not leave. Historical trends show that once a tourist leaves a foreign country, the hospital's incentive to help with paperwork drops to zero. Having these physical documents in your hand when you land back in the United States increases the speed of your reimbursement by potential outcomes of 60 to 90 days. The 23rd mistake is ignoring the time limit for filing a claim. Many U.S. tourists return from a stressful trip and want to forget about the emergency for a few weeks. They wait until they are settled back into their work routine to start the paperwork. In 2026, many insurance contracts have shortened the window for filing a notice of claim to as little as 20 or 30 days from the date of the loss. If you wait 2 months to submit your hospital bills, the insurer can legally deny the claim based on a violation of the reporting timeline. Case studies indicate that the most successful claimants are those who start the process while they are still in the destination. Most insurers now have a mobile app that allows you to photograph receipts and submit them in real time. By the time you land at your home airport, your claim should already be in the system. To avoid the filing limit trap, you should set a calendar reminder for 7 days after your return to perform a final audit of all expenses. If you are still waiting on a final bill from a foreign provider, notify your insurance company in writing that a claim is forthcoming. This placeholder keeps your legal rights active, even if the final documentation takes longer to arrive. We have now covered the financial logistics of the hospital checkout, the secret power of emergency cash transfers, and the critical importance of the discharge summary. You now understand that your credit card is a medical tool, and that the clock starts ticking the moment you land back on U.S. soil. You are nearly at the end of this masterclass, but there is one final, overarching philosophy of travel insurance that ties everything together. It is the difference between having a policy and having a plan. In the final part of this series, we are going to conduct a live policy audit. We will take everything we have learned, from the pre-existing condition waivers to the 24-hour reporting rules, and apply it to a real-world scenario. We will also reveal the one thing you must do 5 minutes after you buy your next policy to ensure you never lose your documents in a crisis. We are going to look at the future of travel insurance in 2027 and beyond, including how AI-driven adjusters are changing the way claims are processed, and what you can do to ensure a human always reviews your file. If you want to move from being a vulnerable tourist to a protected global traveler, the final step is the most important one. To understand how to finalize your protection, we must look at the 24th mistake: the digital documentation gap. In 2026, relying on a physical folder or a single email in your inbox is a recipe for disaster. If your phone is stolen or your luggage is lost, your access to your policy number, the emergency contact line, and your proof of coverage vanishes. Imagine a traveler named Marcus from Philadelphia, who was hiking in the Scottish Highlands. A sudden storm caused him to slip, resulting in a severe ankle injury. His phone was water damaged and wouldn't turn on. Marcus knew he had insurance, but he couldn't remember which company he used or how to reach their 24/7 assistance team. Because he couldn't provide a policy number to the first responders or the local clinic, they could not verify his coverage, and he was asked for a significant cash deposit before specialized imaging could be performed. Historical trends show that travelers who use the parallel storage method have a much higher rate of immediate care. This involves 3 specific steps that you should take 5 minutes after purchasing any policy. First, print a physical copy of your insurance ID card and keep it in your passport cover. Second, save a PDF of the full policy document to an offline folder on your phone and a secondary tablet or laptop. Third, and most importantly, email a copy of that PDF to a trusted family member back in the United States. In a crisis, that person becomes your ground control. If you are incapacitated, they can call the insurer on your behalf and provide the necessary authorization codes to the hospital. This simple administrative redundancy is what separates a chaotic emergency from a managed medical event. The 25th mistake is the failure to conduct a final verification of the policy expiration time. Most U.S. tourists believe their policy expires at midnight on the date they return. However, in 2026, many international insurers use Greenwich Mean Time, or the time zone of their corporate headquarters, for the official expiration timestamp. Imagine a traveler named Sophia from New York who was flying home from Sydney, Australia. Her flight was scheduled to land at JFK at 11:30 p.m. on a Tuesday. Sophia set her policy to expire on that Tuesday. However, due to a massive headwind and a gate delay, her plane didn't touch down until 1 a.m. on Wednesday. While she was walking through the terminal, she tripped over a stray baggage cart and suffered a dental injury. Because the accident happened at 1:15 a.m. on Wednesday, and her policy had expired 90 minutes earlier, her claim for the $3,000 in dental repair was denied. Case studies from 2026 suggest that these time zone overlaps are a frequent source of technical denials. To avoid this, you should always set your policy expiration for at least 48 hours after your scheduled arrival in the United States. This provides a buffer for long-haul flight delays, missed connections, and the simple reality of international datelines. The cost of adding 2 extra days to a policy is often less than the price of a single airport meal, but it ensures that your coverage is active until you are safely inside your own home. You should treat the end of your trip as a transition period, not a hard stop. This leads us to the 26th mistake: the abandonment of the appeal process. Many American tourists receive a claim denial letter and simply accept it as the final word. They assume the insurance company has a team of lawyers and that fighting the decision is a waste of time. In reality, historical trends in 2026 indicate that a significant percentage of initially denied claims are overturned on appeal when the traveler provides additional context or corrected documentation. Imagine a traveler named David from Seattle whose claim for a stolen camera was denied because the police report was missing a specific serial number. David didn't give up. He contacted the local police station in Prague, requested a supplemental statement with the serial number included, and resubmitted the claim. Within 3 weeks, the denial was reversed, and David received a check for the full value of the gear. The step-by-step approach to a denial is to look for the specific denial code or reason stated in the letter. If it is a lack of documentation, you can almost always fix it. If the insurer claims a condition was pre-existing, you can provide a letter from your primary care physician in the U.S. stating that your health was stable during the look-back period. In 2026, many travel insurance companies use AI-driven software to perform the initial claim review. These systems are programmed to flag any discrepancy, no matter how small. By filing a formal appeal, you are often forcing a human adjuster to look at the file for the first time. A human can see the nuance that an algorithm might miss. You should view the first denial as the beginning of a negotiation, not the end of the road. The 27th mistake is ignoring the future of travel insurance. the parametric shift. In 2026, a new type of coverage called parametric insurance has become popular for flight delays and weather events. This insurance doesn't require you to file a claim. It pays out automatically based on data triggers, such as a flight being delayed by exactly 3 hours. The mistake travelers make is assuming their comprehensive policy includes this feature. Usually it does not. If you want the convenience of an automatic payout, you often have to purchase a specific parametric add-on or use a specialized app-based provider. Case studies show that travelers who combine a traditional comprehensive policy with a parametric flight delay rider have the most seamless experiences because they receive immediate cash for airport expenses, while their larger claims for hotels and missed tours are processed through the standard channels. Finally, we must address the most important philosophy of the masterclass: the plan versus the policy. Having a policy is just a piece of paper. Having a plan means knowing exactly who you are calling first, how you are paying for the hospital, and where your documents are stored. In 2026, the global travel environment is more complex than ever before. Civil unrest, climate events, and evolving medical protocols mean that the old way of traveling, just showing up and hoping for the best, is a high-risk strategy. By avoiding these 7 common mistakes and their dozens of technical subtraps, you are not just buying insurance. You are buying the ability to take risks. You are buying the freedom to explore remote corners of the world, because you know that if something goes wrong, you have the legal and financial framework to handle it. Step by step, before your next trip, you should perform a mock drill. Ask yourself, if I am in a hospital in Tokyo tonight, do I have $10,000 in credit? Does my brother have my policy PDF? Do I know the name of my heart medication dosage from 6 months ago? If the answer is yes, you are a professional traveler. Historical trends suggest that those who prepare for the worst actually enjoy their trips more, because they have removed the underlying anxiety of the unknown. You have moved from a state of vulnerability to a state of empowerment. As we conclude this 10-part deep dive, remember that the insurance industry is built on definitions. If you know the definitions, you own the outcome. You now have a roadmap to navigate the look-back period, the 24-hour reporting rule, the hospital of choice clause, and the administrative precision of the 100% valuation rule. This knowledge is your most valuable travel accessory. It weighs nothing, it costs nothing once you have it, and it can save you hundreds of thousands of dollars. The world of 2026 and 2027 will continue to present new challenges, from AI-managed claims to shifting travel advisories. But the fundamental principles we have covered here, documentation, disclosure, and due diligence, will remain the gold standard for protection. Your next trip is an investment in your life experience. Protect that investment with the same care you used to earn the money that paid for it. Now that you have the framework for insurance, the next step is to look at the other side of the equation: the actual physical safety of your data and identity while moving through international airports and high-traffic tourist zones. In our next masterclass, we will break down the evolving world of digital privacy for travelers and how to ensure your bank accounts and personal identity remain secure in an era of sophisticated cyber theft.